ever watched those dance competition shows where partners have to be perfectly in synchronization? Well, welcome to the greatest dance competition of all the time, accounting transactions, where every move must be perfectly balanced or the whole routine falls apart. Students, today we are diving into the most fundamental dance in accounting, the debit and credit tango. Once you have understand the rhythm of the transactions, you will be expert in journalizing. In the accounting world, every transaction affects at least two accounts. It's like Newton's law. For every action, there is an equal and opposite reaction. Or, in our world, for every debit, there must be a credit. This balance is what keeps businesses from floating off into financial chaos. The confusion comes because we are actually looking at two different approaches at the same thing. In our previous videos, we have discussed the traditional approach and modern approach while maintaining the double entry system of bookkeeping, right? So the traditional approach classifies accounts into real account, personal account and nominal account. Whereas in the modern approach, it simplifies it to just assets, liabilities, income and expenses. But here is the secret sauce. No matter which approach you use, the results are exactly the same. It's like getting to the same destination through the different multiple alternative routes. Right? So now let's visit our fictional business, a textile showroom owned and managed by Tara, the owner. So let us understand the transactions. Let us and analyze the traditional approach classification, modern approach classification, the effect of the transaction, and the debit credit rule applicable on those transactions. First transaction, capital brought into the business. The two accounts involved here is cash account and capital account. Cash is a real account as per traditional approach. Capital is a personal account as per traditional approach. Whereas in the modern approach, cash is an asset, capital is a liability. Now, we have to be very careful while applying this debit credit rule. Students, first we have to be very sure about the understanding of the transaction. So, when the capital is brought into the business in the form of cash, cash increases and capital also increases. See here from the separate entity concept, business point of view, we are doing accounts. So for the business, the capital is a liability. So when the liability increases, it has to be credited. Whereas business is getting cash in the form of capital. So cash is an asset increasing, you have to debit. So this is how you should apply the debit credit rule. The second transaction, for example, building purchased through check. For a textile dealer, building is a fixed asset. So when building is purchased through check, for business, the building is coming in and bank account is decreasing, actually going out of the business. So the two accounts involved here is the building and the bank account. So the building is a real account, whereas bank is also a real account. As per modern approach, building is an asset, bank is also an asset. So building is increasing, bank is decreasing. So when the asset is increasing, you should debit. When asset is decreasing, you should credit. So building account debited to bank account. Another transaction, let us understand. The purchase of goods for cash. So when the business is purchasing goods, the goods is coming into the business and the cash is going out of the business. The two accounts involved here is purchases account and cash account. So purchases is a nominal account as per traditional approach, whereas cash is a real account. And as per modern approach, purchases and expenses, whereas cash is an asset. So in this case, transaction when goods is purchased for cash, so purchase account will increase, purchase expense will increase, and cash asset balance will decrease. So the journal entry will be purchase account debited to cash. Another transaction example, carriage inwards paid. So carriage inwards is basically an example for expenditure incurred by the business while purchasing. Carriage outwards, contrastingly, it is towards sales. So carriage inwards paid here means carriage inwards is an expenditure and another account involved here is cash. So as per a traditional approach, carriage inwards is a nominal account, cash is a real account. As per modern approach, carriage inward is an expense, cash is an asset. So carriage inwards is increasing, cash is decreasing. So the debit credit rule will be carriage inwards debited to cash account. Next, cash paid to creditor. These are the examples we have randomly picked to understand the debit credit rule. There is no synchronization or chronological order we have taken these examples. This is only to enlighten students how different transactions in the business are generalized. So cash paid to creditor. So what is cash paid to creditor? Creditor is the supplier who had supplied goods on credit basis earlier. When cash is paid to them, the two accounts involved here is creditor and cash. So creditor being a personal account as per traditional approach and cash is a real account as per traditional approach. Whereas as per modern approach, creditor is a liability, cash is an asset. So creditor is decreasing. Whenever you pay off the liability, pay off to the creditor balance will come down, right? The liability decreases. Whereas whenever you pay cash, cash goes out of the business, the asset decreases. So the journal entry will be creditor account debited to cash account. Next, cash sales. The two accounts involved here is cash and sales. The cash comes into the business and sales means income increases. So as per traditional approach, cash is a real account, sales is a nominal account. Whereas modern approach, cash is an asset, whereas sales is an income. So whenever cash sales happen, cash comes into the business, so cash account increases, whereas sales is an income, it increases. So increase in cash, debit, increase in sales, income, credit. Cash account debited to sales account. Another transaction example, carriage outwards paid. This is similar to carriage inwards paid. So let us take another example. Cash received from debtors. So two account involved here is cash and debtors. Cash is a real account, debtor is a personal account. Whereas modern approach, cash is an asset, debtor is an asset too. Here when debtors pay cash to us, business as a business when we receive cash, so cash balance increases, whereas asset debtor balance will decrease. So cash has to be debited, debtor account has to be credited. Discount allowed to debtor. Whenever debtor makes payment, we allow discount to them. So discount allowed is an expenditure to the business. So as per traditional approach, discount is a nominal account, whereas debtor is a personal account. As per modern approach, discount is an expenditure, debtor is an asset which will be decreasing. In this case, discount allowed expenditure increases, debtor balance decreases. So the journal entry will be discount allowed account debited to debtor's account. Another transaction can be interest received. In the case of interest received in the form of cash, two accounts involved here is cash and interest income. Cash is an asset as per modern approach, whereas as per traditional approach it is real account. Whereas interest income is a nominal account as per traditional approach, whereas as per modern approach it is income. I repeat, cash is a real account and interest is a nominal account as per traditional approach, whereas cash is an asset and interest is an income as per modern approach. So cash in this case increases, interest income also increases. So the journal entry will be cash account debited to interest account.